All right, let's get started with the first conversation. And indeed, about a year ago, when I spoke to my next guest, we spoke about the whole argument between passive and active investing strategies. And what he was talking about at the time was that a lot of people are now considering doing a combination of the two. Indeed, the strategy that we're going to be talking about today is a bit of a mix between the two elements. It is passive investing with a bit of a twist. We're going to talk about smart beta, what it means and what the various options are and how things have changed even from that point in October last year when I last spoke to him about this topic to where we are right now. Chintan Haria, Head of Products and Strategy at ICICI Prudential AMC, thank you so much for taking the time for speaking to ET Now on The Money Show. I'll start, I think, with the most basic question, Chintan. For those of my viewers who are not familiar with smart beta, what is it and what is the ethos that governs this strategy?
Good evening, Alex. And yes, it's been 12 months of interesting activity on the smart beta side. But just to recap as to what smart beta is all about, traditionally, any passive fund, if it is following an index, the index itself has a market cap based weighting and selection of stocks. So let's say the top 50 names of the market would form the Nifty 50, the top 30 names say Sensex 30. In smart beta, essentially, if we go back and see what active fund managers do, active fund managers have a particular style. Some of them are growth oriented, some of them are value oriented, some of them are highly conscious about the return on capital employed. Some of them want a stable product, so they basically follow stability of stocks. And that's what smart beta is all about. Smart beta is a concept by which the selection of the stocks is based on a factor or a multiple factors which are chosen and known to the investor beforehand. And as a concept, it is picking up significantly. So unlike a traditional passive fund, a smart beta fund is where the selection happens on the basis of a factor and the weightages also are not basis the market cap. So a large company will not necessarily have a large weight in the smart beta portfolio. It will have basically weightages which are determined by the factor. Obviously, explanation on the factors which are working, etc. we can have. But the concept is very simple. Like you said, it's a mix of bringing in an active element in terms of selection through a methodology-based factor, which is already pre-decided. And a large portion of investors, especially in the HNI segment and the family office segment, are warming up to this particular category. And this category has seen a growth in India as well, much like how it has seen a growth in the global world.
Absolutely. And in fact, even at this point, Chintan, I think it would still be fair to say that we are still lagging in terms of the offerings that are there. But still, I think the number of offerings that are currently available has also increased significantly since the time that we spoke last year. So let's talk about these factors. And index funds, like Chintan was pointing out, is basically something that mirrors your index. So in the event that you're talking about a Sensex fund, then it would essentially have the 30 stocks of the Sensex and it would be in that same ratio of the market capitalization of each of the stocks. So therefore, Reliance Industries, for example, would have the largest the largest allocation of resources in that index. Let's talk about these factors, Chintan. What are the top ones that come to mind and how do they affect the selection of the stocks?
Right. So factors can be price-related factors, can be fundamental factors which are based on balance sheet or profit and loss account. Just to name a few, for example, if you want a portfolio of the most stable stocks, right? So you will pick up a universe first. Let's say the top 100 names in the market, and out of the top 100 names, you pick up 30 names which have been the most stable. We call it the lowest volatile stocks in the last 1 year, and you create a portfolio out of that. By the weightages are also basis the lowest volatile stock getting the highest weight. That basically is your low volatility based fund. That is one, and it is the most popular smart beta category in India right now because of the fact that low volatile stocks on a risk adjusted basis in the long run have done very well in India. The others, let's say, it could be valuation based. So if you have a portfolio wherein you pick up, let's say, the top 20 names out of the top 50 names in Nifty, you pick up on the basis of price to earnings, price to book, return on capital employed, and dividend yield. You add these factors and you basically create a portfolio. Like I said, the popular one is the low volatility. On top of that, of course, momentum is also as a factor picking up, because the last 1 year, if momentum stocks have done well and that has been part of your portfolio, momentum as an indicator or momentum as a strategy within the smart beta space would have done well. So you have two basic, let's say, pillars. One is price based, so anything to do with the stock's price, and if you make a selection on the basis of the prices of the stocks. And the second is fundamental based factors. You pick up the stocks which have the highest sales growth, you pick up the stocks which have, let's say, highest dividend yield. The idea is that something which works for an investor in the long run is something which the product should be. And in India, like you said, the concept of passive fund itself is relatively new. So people were building blocks in terms of the traditional market cap based indices or ETFs. That has been done. And now you're finding more and more options within themes and sectors. And of course, smart beta, like we have the ICICI Prudential Low Vol 30 or ICICI Prudential Alpha Low Vol 30, we will basically see even the peer group as well as the entire industry adding on to the smart beta space as we move along, because factor-based investing can be a good way for at least investors to know exactly where they are investing, and we are seeing traction in that.
So, Chintan, just to argue the other side, okay, and I'm playing devil's advocate here. To a certain extent, you've already listed out the pros. We can talk a little bit more about the pros, but a bit of a well-researched investor looking at these options would perhaps ask the question, why should I complicate things? Why should I go for a smart beta? I can go for index plus active. What are the key advantages for me to choose, say, a smart beta fund over a traditional index fund?
Fair. So, like you said, that there are enough smart investors, and in India, the beauty is there are enough number of investors for each kind of category. So there are people who are basically liking the idea of, let's say, low volatility and investing there, because in their scheme of things, the way they have set up their portfolio, they want something which has a stable element around it, or which picks up stocks which are stable. So it's not necessarily a comparison between active and passive. And like we've always been saying, active, passive, be it smart beta or otherwise, are all complementing products in terms of allowing India to go an equity way, or increasing the financialization of India towards equity, which in itself is quite low. And as part of the overall mix, the smart beta products relative to a pure index fund can add that bit more value, as long as an investor is comfortable with what he's getting. You mentioned about pros, which I've already spoken about. The other way to look at it is that if you pick up one particular factor, let's say low volatility, there may be times like last 1 year wherein the higher beta names have turned around and they've done much better. So there will be phases in which a particular factor does well. There will be phases in which a particular factor does not. And to that extent, a smart beta portfolio on a particular factor will be constrained. So nothing is perfect as such, but if you like that particular profile and if it fits your overall allocation, because you're not going to invest 100% of your money in any particular strategy, you will divide it. And as part of division, you will find that investors are warming up to smart beta as well, because it fits each investor's ethos. So an investor may have, let's say, an active large cap category, active dynamic asset allocation category, or the balanced advantage fund category. Within that, if they feel that, okay, markets last year had a momentum which was going to come, they can basically participate in the momentum through either the momentum ETF, or let's say they want more stability, then they'll participate in the low one. So it's a portfolio approach wherein you create a balance between active, passive, and smart beta, which will work for investors in the long run. And if you don't want to complicate it, I would guess that keeping a steady state allocation once you've selected the portfolios would also work well for investors.
I'm also curious, Chintan, on how each of these strategies are determined. So if you talk about your own methodology, you must have done certain tests that gave you certain insights as to how this is done vis-a-vis traditional products, and in what situations these are important. So I'm trying to get the viewer to see in what situations something might work and how to approach it. So from the answer to the last question I asked you, I'm getting the sense that you're saying that this is something that will help you diversify your portfolio, your investments, that will help you fine tune the approach that you want to have basis what you're seeing in the market. So, for example, an equal weight strategy as opposed to a market cap strategy is something that you look at when you think that the broader markets or the stocks that generally don't perform are likely to perform over a 12-month period. So, what should the approach be when deciding which to go for?
Fair enough. The approach is essentially something which will be determined on your entire overall portfolio mix. So like you mentioned, equal weight, I think, has had a 10 to 12 percentage points uptick over a traditional market cap based index for the last 1 year because of the fact that the wider set of market has done well in 2021, while in 2018-19, it was such a constrained market that only the top 10 names did well. So you rightly mentioned in equal weight, there is a timing element involved. So there will be certain funds which will be probably tactical, but there will be certain categories, like we believe the low wall, for example. It's an allocation which is for the long term. Like you mentioned, if you look at the back testing, if you look at the way the structure is, generally the weightages of the stocks are not more than 5-6% on the upper end. They are probably in the range of 3 to 6%, a well-diversified 30 stock portfolio across sectors, and the sectoral rotation also keeps happening. Predominantly, of course, the steady names are in the pharma, consumer or IT space, but you do occasionally find even autos getting a representation, PSUs getting a representation. So it's a good way to have allocation to a fund which you know on a risk-adjusted basis will do well, because lower volatile stocks, which essentially is risk, would mean that you are taking lower risk to participate in the market. So there will be certain smart beta categories which will be for the long term or structural. There will be some which will be tactical. I would believe momentum to an extent will be tactical, because in good markets, momentum can help you. But when the market turns, momentum can hurt as well. So it's essentially for people who are understanding the underlying portfolio and adding to their existing portfolio. So much like we say, have a core allocation to dynamic asset allocation on the balance advantage fund category within the active space, build it on top of it with a little bit of gold also, and add the smart beta factors, which you feel add to your own, let's say, the way you are as an investor, and build a portfolio which will work well for you over the long run.
My last question, and this is something I think I had asked you back then also, is that you have the ability at the start when you launch these smart beta funds, Chintan, within the larger scheme of things, to pick and choose these factors. Do you see the potential for more nuance, more fine tuning, and do you see that this space will develop very quickly in the near term?
Yeah, so like you had said, that 2017 is when we launched the low wall, and it's been a journey that we basically traversed in terms of understanding, in terms of investor acceptance, and with more and more investors, are looking to allocate and allocating, and we're seeing that in terms of translation into AUM as well, or the assets under management. There will be more nuances. There will be more work towards what will fit an investor's requirement well. The idea is that something where there is let's say, that will fit in an investor's overall portfolio to add some value. Those are the products which we would like to bring, and there are enough number of opportunities or nuanced opportunities which are there. It is something which will happen over a period of time as we see more and more investors warming up to the passive side. And we have no doubt that probably the number of, let's say, offerings or the number of various alternates within the smart beta space across the industry itself will keep on increasing as we see more and more investors warming up to the idea of smart beta indices.
All right, Chintan, always a pleasure speaking with you, and I certainly look forward to speaking to you at more regular intervals in the future. Thank you so much once again for taking the time.
Thank you.
All right, on that note, guys, we're slipping to a short break, but there's more on the other side, so do stay tuned.